Hey, thanks very much. Welcome back. I just found out from Chuck Malamut that you enjoyed a concert during the news break as well. So we got that going for us as well. We had Caught with the Wind and other things going on because it plays the next song after that. It's a really cool soundtrack that we have. Possibly even was playing a little Forrest Gump. Chuck Malamut is here. This is a weekly program that Chuck has been doing. Well, this is the 26th year of this program. On Tuesday, in the 8 o'clock hour, imagine some things are enduring. Rosemary wrote me something about enduring in a poem that she wrote last night in Ventnor. And the Chuck Malamut program is enduring as we continue in our 26th year together. Chuck is the managing director. He leads his group, the Malamut team, the Malamut Group at Morgan Stanley's Northfield office. Their number to reach them for all of your financial planning needs is 609-383-2010, 609-383-2010. Let them go to work for you like they have gone to work for so many good people and show you their concept of total asset management and the proper asset allocation strategy that they employ on your behalf. This program that you're about to listen to is presented by Chuck Malamut. He is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Without further delay, the melodious voice of Chuck Malamut.
Good morning, Harry.
Hey, Chuck.
I want to make certain that you're working hard.
Chuck, you see my eyes, man. I'm bleary-eyed. I am working real hard, but I'm happy about it. A lot of good things going on, a lot in general going on.
That was an insight.
I know. Now, I will say this, though, and I know you have a whole outline. You do a great job with your show prep, but I've been paying very close attention to earnings, and there were some bad earnings. I think one company in particular is going to have a very bad day today, and then there are some more earnings that are going to be coming out. We've seen record after record after record, day after day, it seems, with the Dow. How are things going, Chuck?
Well, Harry, actually, we've seen more beats than misses of late. And what's going to happen? There's a lot going on this week. Literally, as you know, when you get to this time of the quarter, you're just deluged with earnings. And as an example, this morning, Goldman Sachs beat.
Good.
Johnson & Johnson beat. United
Good.
Health beat.
Oh, good.
Philip Morris International missed. IBM was right on target, I believe. Netflix, I think that might be what you're referring to.
Yeah.
Their number last night was okay, but their subscriber growth was slowing. So their stock came under a fair amount of pressure after hours, and I would expect the same thing as we get into today. As you mentioned, Harry, the S&P, Dow, they continue to move in an upward direction. Last week the S&P was up 1.5%. Third straight week in which our equity markets appreciated by more than 1%. I think there's three things that are driving the market at this point in time. Equities seem to be more attractive than fixed income. As you know, bond rates are just down significantly. We'll get into why that's happening. Corporate earnings, as we kind of chatted about just a minute ago, for the next 12 months or so, the outlook seems to be somewhat positive. And, there was a lot of discussion and a lot of anxiety with respect to Brexit. And it looks like that what will be happening should be fairly well contained because of what's happened in the stability within the banking system here, mostly international banking versus here domestically.
Chuck, one geopolitical comment, because you do recognize and often comment on your show about the market's risks insofar as geopolitical issues. Great Britain turning over prime ministers like that out of nowhere. Cameron was supposed to stay till October. Next thing you know, he's leaving tomorrow. They turned it over, and you don't even really hear a word about it. Most people don't even know the new prime minister's name. It's a female. People are comparing her sort of to Margaret Thatcher. I think that's a little overheated until you earn that. But nobody's saying a word about it, basically. It's quiet as can be.
Well, Harry, look, as you well know, the media goes through these fits and starts, so to speak.
Because they were hysterical, Chuck.
And to try to create oftentimes news that is not even noteworthy. And I know we're not going to talk politics on this show, but I will tell you, Harry, I know that you were up very, very late and up very, very early.
Yes.
So when I use the word early in the morning, I guess I'm plagiarizing.
Evidently.
Okay, so
yeah.
I mean, her speech was, I thought, fantastic.
It was elegant. It was smart. It was great. But they found maybe 10 words that were similar to 10 words spoken by another person, and they made that the story.
So what the media, with respect to Brexit, what has happened now, the media has moved on. And they're now trying.
They're bored with it, aren't they? That's what they are. They get bored.
They want to pick, what they're going to pick on next, so to speak. And now
that's no longer sexy and hot and relevant. It's just yesterday's news, so they don't even report on it now.
No, it's going to take, some time to work through Brexit, as we know, and we at Morgan Stanley just recently changed our asset allocation modeling, reducing just ever so slightly our percentage allocation to Europe and Japan as well. Meaning
less of it.
Meaning less, and moving those percentages. I believe it was about a 2% move over back to domestic U.S.
Good.
And
it's a good call.
Certainly the U.S. markets have performed better than what has been happening, overseas, and that's obviously a good sign. So when you take a look, one of the things we kind of chat about as we got to the end of the quarter, emerging markets and high yield and commodities were one of the best performers. So now, as we kind of go across the board, the best performing market internationally is the MSCI MSCI emerging markets up, and who would believe they're up 11% year to date. The S&P 500, the Dow Jones are both up, Harry, between almost 7 and 8%. And the move happened, as you know, very, very quickly. We were basically going absolutely nowhere for the longest time. And this is a true testament to trying to stay the course and being a patient investor, because you had ample opportunities, to raise the flag and say, I surrender, get me out. But if you stayed the course, you should be relatively happy with what has happened, not only in the equity markets but also with fixed income as well.
Chuck Malamut, is it true that the major indices are all in positive territory right now for the year?
They are. As I mentioned, the S&P
pretty extraordinary when you think about the year we've had.
Yeah, S&P up 7.8, Dow up 7, and the Nasdaq just Harry squeaking by up 1.1%. Because if you take a look at these sectors, the breakdowns of the S&P 500, the best performing sectors year to date, telecom, utilities, and energy. Who would ever believe that energy is up almost 18% year to date? The sectors that have not performed: financials, healthcare, and technology. So, as you know, the Nasdaq is a fair amount, mostly technology type companies. So, if the Nasdaq is up 1.1% for the year, technology as a whole is up 3.8. Compare that to telecom up 26.3. So, you need to be a little bit selective at times and somewhat nimble if possible. But I guess the lesson to be learned here, Harry, is to, try not to pay attention to what goes on hour by hour, because you will get totally whipsawed and make some very, very poor decisions that you will regret later.
We're going to take a brief time out. We're coming right back with Chuck Malamut. We're at 15 minutes past the hour, this portion of Early in the Morning on WPG Talk Radio 104.1 FM, 1450 AM, and throughout the world at WPGTalkRadio.com. 18 minutes past the hour. Thank you, great one. We're with another great one, Chuck Malamut, the official financial advisor to the Early in the Morning program. Turn to Chuck for all of your financial planning needs. The Malamut Group standing by, 609-383-3776. 2010. That's 609-383-2010. All right, so strong market update, Chuck Malamut. How about second quarter growth? What's going on?
Sorry, Harry, I was just a little bit late getting the,
you aren't late.
Headset back on. I was trying to multitask. You know what happens.
You're making a contribution to a great cause is what
you're doing. So anyway, Harry, second quarter growth, I hope you – the good news is you don't have a lot – you're operating on very, very little sleep here.
3.5 hours.
So I might be able to sort of sneak this through and you might not catch it. But the economy – we think second quarter growth should improve, but we think as we get into the third quarter it might slow a little bit. As we know, and you said it on...
Might slow a little bit? Was that from 0.3? From 0.3 to what?
Harry, let me finish.
0.0?
Harry, let me finish now. First quarter real GDP came in at 1.1%.
Woo!
We believe the second quarter should come in around 2.5%. We think that pace might slow a little bit into the third quarter because of deteriorating U.S. trade conditions. Declining business confidence, and we can talk about that all day long. By the way,
in our new America, Chuck, will that be considered brisk growth?
I think it might be.
Will that be brisk growth?
I think it would be considered above average. I guess is the best way to put it because
not that long ago, 4.6% was considered the worst ever.
The new average seems to be anything around 2 seems to be acceptable.
Only because who's in there, but I'll save that for my time. It seems to be acceptable.
As I mentioned to Harry, declining business confidence, and then what we oftentimes talk about is consumer, and we think that consumer spending, might slow down a little bit. And if you take a look at what's happened at the price of the pump,
time out 1 second.
It's pretty obvious that might happen.
If consumer spending comes down, is that a lack of confidence in the economy?
Well, we're not. I'm not going to say it's a lack of confidence. I think it might just be a lack of resources more than anything else. Because if you look at our economy here domestically, it certainly looks a lot better than what is happening overseas, and that is indicative of what's happening with interest rates. So the question is 2% acceptable? Absolutely not. Is 2.5% acceptable? Well, it's certainly better than 2 and certainly a lot better than 1.1. And I mean, as I was listening this morning, I did everything I could, Harry, to just kind of catch my breath and say, "Oh my goodness, I can't wait till just November gets here. It can't get here quick enough."
Yeah, because it's a bad environment to operate in everybody's world, not just the world of a great financial advisor, but in everybody's world, because everything is through this buzzsaw, whipsaw of politics, and it just affects everything. People make crazy statements. People want to win at all costs. It really is a tough environment to operate, isn't it?
Harry, it's very tough because, during our day, we try to concentrate on managing, with our clients, not only their assets and their liabilities, but their expectations. And as you get sort of these whipsaw actions within the political world, and then, as you know, just the media has a tendency to sort of hyperventilate over anything that is typically working the wrong way, investors get very, very concerned and very, very upset. And I think what bothers us is the fact that we have to spend sometimes an inordinate amount of time, making certain that our clients feel comfortable, because you have those outside sources just throwing grenades at you all day long. And it's at the end of the day, it's really kind of sad. Because
let me pay you a compliment, because for those that don't know Chuck, and those that are his clients, and I know many of his clients listen to the program each week, and perhaps some people out there that are prospectively looking at Chuck and his team. Chuck has an incredible talent for slowing things down when everybody else is going crazy, and all this incendiary language and all this political just insanity goes on. Chuck is very good at slowing things down and reminding folks, that you're in a long-term strategy towards that goal, whether that goal is retirement or any other, mile markers along your lifetime's path. Chuck, that's one of your great strengths. I've always seen that in you, from your casino senior executive days to all these decades in the financial services industry, that you are able to do that. It's a very difficult thing because it requires a lot of skill, a lot of smarts, an ability to not pay attention to things that really don't matter, and to compartmentalize is the word that I was looking for. And for those listening, Chuck is a brother to me, and you could say Harry's biased where Chuck is concerned, but I promise you everything I said is true about you.
Thank you, Harry.
I will say that it's a big deal.
Well, all of us have a tendency as we become a little bit older to become hopefully a little more patient and understanding, about life and what goes on in life, whether it's something in what you do every day in your business or something you do within your family and the way you handle certain stress levels. And I think, Harry, that if we go back into our 20s, which seems like it was a life ago. I mean, we handled things differently then than we handle now. And I mean, it's oftentimes you say to your children, all I'd like to do is cut my head off and put it on your body, and you would have a lot more knowledge and just handle things differently than you handle things now. And I mean, it's something that all of us live through. And I'm not telling any stories.
I also think because, and other generations have said the same thing, but I really believe because something that had never existed in this state, and particularly in our region, had never existed before, it was an amazing proving ground at such a young age. And we had positions beyond our years. And then you start to look at your own children and at their ages, and you think about what you were doing at that age, and it is kind of remarkable, isn't it?
Yeah, Harry, there's no comparison. It takes, now you can't graduate in 4 years. You got to go 5 years for a four-year degree because either the classes aren't available, or you need to take more particular classes in what you're majoring in, and then maybe you go beyond the traditional education to 4 or 5 years, and you seek MBAs or your doctorates or whatever. And bottom line, end of the day, that's all great, but the problem is a couple things happen. And I mean, we're not telling you anything your listeners don't know. You create more debt. It's a drain into the household. It's a drain to the student, and ultimately, because of the lack of growth that we just talked about at 1.1 or 2.5, it's better than it was, but graduating from college, it's a chore, securing good quality employment out of the gate.
Keeping politics completely out of it and just treating this as dispassionately as we can. How were we able to grow above? And I understand generations are different and things are going on, and even you could talk about the war effort and how that stimulates the economy back in the World War II era. But even during the Great Recession, we had multiple quarters where we grew at over 3%. How can we not have a single quarter at least 3% for going on 8 years?
Harry, I saw something this morning as I was getting ready, and on a station that we won't talk about,
NPR.
And it's not NPR, but entrepreneurship, continues to trend lower, and that is something that I think all of us understand, and it's pretty simple to understand why. And if you take a look at what is happening here in the state of New Jersey, in particular, they're discouraging growth. Mm-hmm. They don't want businesses to grow. They don't want all of us to improve our homes, because unfortunately you either have some sort of government entity or agency in your pocket looking to grab what you have worked so very, very hard for. So it's sort of it's self-defeating, because Harry, if I asked you, Harry, would you start a business right now? If you had an opportunity, would you?
No.
Okay. And you ask your listeners?
I'm happy to have the businesses I have already started, because the environment right now in this state is not conducive.
No, it's absolutely not. And unfortunately, I think, as we won't talk politics, but, the 23-cent gas tax. I mean, that
37 cents.
I mean, it just sort of, it never wants to go away.
They want 37 cents
because now what happens is because the state or the federal government has such an appetite for your dollars, you have to work that much harder to be able to save, and it's just. And if it's a very vicious circle that we're in right now.
And if you're burning regular unleaded and you can get it right now for even under $1.90 a gallon, my corner store is $1.91. You add 37 cents to that. I mean, that's a big bite. You're talking about a substantial amount each time you would fill the tank, and it's no good. I mean, I follow the Malamut rules of, what did we arrive at? $1 billion plus for every penny that you charge more. That's out of the economy and discretionary spending. It's devastating. So let's get our bottom of the hour break. Chuck has a lot more to share with you when we come back. He's going to talk about bond yields, any other geopolitical risks that are out there, the stock market, positive or negative, and a whole lot more with the official financial advisor, the exclusive and official financial advisor to the Hurley in the Morning program, Chuck Malamut. His team is at Morgan Stanley's Northfield office, the Malamut Group, which Chuck leads as its managing director. 609-383-2010 for all of your financial planning needs. Hey, thanks very much. We're with Chuck Malamut, our official financial advisor to the Hurley in the Morning program. And Chuck, I know that among other things that you want to talk about in the remaining segment that we have here until 45 minutes past the hour, bond yields.
So Harry, as we mentioned before, we think that the bond yields over the next 6 months to a year are going to probably trend higher. If you take a look at what's happening with Treasuries, I think think about traditionally what happens. Bond yields and stock prices, how they react hand in hand. We think that what is happening here, because there's I think $15 trillion of debt globally that is either at zero or negative interest rates. So what is happening now, we're seeing more overseas forces coming into the U.S., buying our debt because of these negative government bond yields throughout the world, causing now a drag on our rates. So, if we have the positive, even though I'll put the word slow, economic growth and a little bit of inflation here in the U.S., we expect the yield should rise somewhat, over the next year or so. As long as those increases, Harry, are somewhat moderate and muted, and they are because of firmer growth levels, we think that such an advance, should support equities. One of the things that we chatted about, and it seems as if we talk about this virtually every week we're together. And that's geopolitical risks. We have looked, take a look at what happened just last week alone. Nice, France, Turkey, the shootings, multiple shootings here in the U.S.
Their economy is rocked, obviously, right?
Yeah,
vacation-wise and all.
What is happening here that the market has done a remarkable job with everything that's happening, particularly overseas. So while geopolitical risks are increasing, they've had limited impact, if no impact at all, financially, across the markets. Now, granted, Brexit with the UK, that's sort of a one-off, but you would think that everything that happened in Turkey, because if you remember, I called you on my way to get out of town for the weekend. What did I say to you, Harry? I said, Harry, this is, I can't believe it, like what's going on in this world right now.
I know. Sidebar, just for a quick moment, I want to let listeners know if you're anywhere near Spruce Avenue and the Black Horse Pike, I would get out of that area. If you can turn off and just get away from it, there is a traffic accident of some kind, and it is really backing up there. And this is a listener writing me directly from the traffic jam. So Spruce and the Black Horse Pike, there's an accident and quite a backup that's happening. Chuck, back to you.
Yeah. So Harry, let's look at the geopolitical risk. I mean, think about it for a minute. We've had a lot, that we've basically had to digest, and unfortunately, these events, I guess the best way to describe are somewhat, they're horrific. I mean,
let me mention something and see if you agree with this. In terms of geopolitical risks, you've talked about them the entire 25-plus years that we've done your show. And I remember back a number of years ago when some kind of political issue would happen, our markets would get rocked.
They would. And
we now seem to have built – I want to ask you if this is a true statement. It now seems to be built in that we're just accepting that these political things are happening in rapid fire, and they don't seem to rock our markets.
I don't want to use the word accepting because I think once you use that word, what will happen is there will be an event
that would be big enough
that's going to create some turmoil in the financial markets. If it would be easy if we could identify what, when, and where, but let's think about this for a second.
Is it partially accurate what I said, though? It seems like there's so many now.
No, we've talked about that because we have become immune to this. And, you think about it, I think it was last summer in France, in Paris.
Yeah, I remember we were in Disney World.
And at that point in time, the markets did reel somewhat, but snap back, fairly quickly. So terrorist attacks, political instability, growing violence here in the U.S. I mean, it's just awful, Harry, what is happening here. And a lot is, directed at the men and women that are here, to serve and protect us. And, obviously what happened in Turkey, and I think that's going to unfold in the next several weeks as to really what happened, because there's all kinds of discussion, like, maybe this was in fact a setup.
That's what I think. It's a listener told me they didn't believe me, but I think it was a setup.
I think it was. I mean,
he wanted to get rid of a bunch of people, and he staged a coup. A very smart listener, his name is Joe, totally disagreed with me when I said that. But Chuck, I'm telling you, I think I said it, and I think you're onto something there with that.
Harry, look, not to sound, not to use a conspiracy theory, type strategy, because we oftentimes talk about that.
And I want to let people know that the tinfoil hat that Chuck is wearing in the studio, I mean, it just goes with the suit he's wearing. I mean, it's nothing. It's just a natural look. Go ahead, please. But I agree with you, Chuck.
No, so Harry, I think that the markets, again, as you identified, they have taken a lot of the geopolitical risks and have sort of put them in certain compartments, and the market has moved on for the most part in an upward bias. And I just find it pretty incredible, everything that's going on, that we seem to be marching in an upward direction. You think about this for a second, Harry. Let's take a look at the S&P for a second. Last week we made new highs. The rally that we're seeing is not just in one or two sectors. It's starting to widening out, and if that bodes well as we get into the future. So, Harry, there's been 28 times since 1900 when the S&P made a new high after failing to do so for more than at least a year. And that's what happened here. It's been a year in the making to make a new high. Looking beyond that, the S&P was higher 25 times out of the 28 potential times, with an average 12-month return of 17%. So now these are,
I don't think a lot of people feel that way.
Statistics are statistics.
Yeah.
And if I came back here a year from now and said, Harry, the equity markets are up 15%, you're going to say, Chuck, how could that happen? So
doesn't feel like that.
It doesn't. So, that's actually a good sign that it doesn't feel that good.
By the way, is that good validation to what you've talked about on your program a lot over the past quarter of a century, and that is not to bird dog it second to second. You can drive yourself crazy with ups and downs that can happen, because look at what you said over, and I'll call that the long haul, but that's not the long haul if you're planning for 40 years, 50 years, but we'll say over a period of time, a reasonable period of time. That is a heck of a story, as opposed to the roller coaster ride when you're ready to come screaming down the hill,
right
now,
at
50 miles an hour.
What I was looking at, Harry, went back to 1900. So let's kind of roll it a little forward, and let's look at, let's use 1950, sort of as a starting point. So there were 15 times since 1950 where it took where you had that 1 year to make new highs, and what happened over those 15 times, 14 of those occasions, the index was higher a year after the new high was made. And then the average gain at that point in time was about 18%. So we're kind of splitting hairs between 17 and 18%. The smallest gain was 3.1%. So I think that what investors need to concentrate on here, Harry, is to make certain that they're, one, properly allocated, and two, within the equity markets, are they owning the right types of equities to be able to participate? Now, I can't sit here, and I will never sit here. I'm not going to tell you or your listeners or our clients that, hey, I'm going to guarantee you that you're going to be up 10% a year. I think that'd be rather foolish, but I still think that you need to be patient in the approach. And oftentimes when we have these discussions with clients and they get amped up, and they get concerned, we oftentimes say, okay, with what I'll call a household, a retail household, and not an institutional account, let's take a step back and pull out your plan. And, is your plan on target or not? And what is your probability of success? Are you are you at 80, are you at 60, or you're at 95? And has your probability of success moved, positive or negative since the last time we did this, based on whatever mitigating factors there might be out there? Having said that, because I see we're kind of short on time, there's more reasons to be positive than negative within the equity market. So investors seem to be, pretty good and comfortable with the fact that where equity valuations are right now, as far as the PE ratios. We think second quarter earnings, as we're seeing now, look to be pretty decent. Fiscal stimulus we've talked about, not only here domestically, but more internationally than anything else. Interest rate movements should be rather subdued over the next year or so. The banking system, and that's what saved Brexit here, Harry, because the banking system was in place to take care of issues with respect to Brexit. So the banking systems for the most part are pretty well capitalized. We're holding steady in our economy. Oil prices, and all the concerns that we had with the Chinese currency. Remember the yuan we talked about in the beginning of the year, which is like every day that's all we talked about. They're receding somewhat, and you're going to like the last one. We think if things go correct in the fall, that there might be some sort of corporate tax reform, and if that does in fact happen, then I think at that point in time, those numbers that you were throwing out, the 3.5% to 4%, I think could become very, very doable.
That would be great to see that again. And obviously, we would be a stronger country when we see that kind of thing. If I could stretch you just 2-minute overtime drill, we've covered a lot of things over the past 25 years. You saw the tech bubble bursting. You saw that. You saw that something was not right. You saw that there were just a lot of things that were hard to explain, the valuations based on that there was no there in many cases. And boy, that burst, and it burst ugly for a lot of people. Some people made a lot of money because they got out. People like Mark Cuban made a lot of money before the dot-com bubble burst. So that was a huge multi-trillion dollar type bubble. The last time I checked, Chuck Malamut, we had about $1.3 trillion in student loan debt in this country, much of which students or parent plus loans have really no ability to ever pay it back. Now, there is a political candidate talking about just making it vaporize and go away. I don't see that happening, but is this the next big bubble that's ready to burst in this country and cause damage?
Harry, I think there's major concern because those loans do not go away. So
you die.
Yeah,
then they're forgiven.
And the problem is in a bankruptcy they do not go away.
That's correct.
And the debt that gets put on the backs of students or families that are supporting the students, and the student gets out of school, they have so many obligations to take care of. So the one thing we oftentimes talk about is buying, is new homes, producing, construction, new construction, and family, growing families. That is, for the most part, been somewhat delayed as these students and these families are overwhelmed with debt. And I think there's a whole, and we could spend hours chatting about this. I mean, I think college is it's a great tool. I think it's, to a certain degree, it's a little bit overdone. And you look at the way these institutions operate, and I'll save my comments for myself, but if you were running your business the way they run their business, it's kind of like government. You'd be out of business.
It's tough. I mean, as you know, you're a dad, and I am as well, and I had 3 children that went to college. It takes 5 years now to graduate. It's very hard to do it in 4. That's just to get the BS or BA. A lot of jobs today now, because it's so competitive and there's so few jobs. Really, a BA, what you used to be able to get with just a high school diploma and some talent and some maybe life experience, you don't even get now with a BA, and then on and on and on. So people are going for more and more. Masters is looking like it's not enough in many cases now. They're going for the next one after that, a doctoral of some kind, whether it be EDD or some other type of doctorate. And this debt it's unsustainable. I mean, you're talking about right now 50 million or so Americans that have massive student loans, whether they are the students themselves, and then those payments start to be due 1 year after they graduate. So the government is very good to you. They say, look, we'll give you a year to find your job and get, a salary going, because then you have to start paying. You get 3 years of forbearance, and then that's that. You're done. You're done at that point, and then you have a strangling monthly payment that in some cases, Chuck, is more than a mortgage payment.
Yeah, and Harry, that is a concern, obviously.
So there's your mortgage. There's your home. Your home is that student loan payment for 50 years or whatever the loan is for.
And you're living where?
You're renting. You're paying somebody else's mortgage.
Exactly. You got it. All right, Harry, look, great show today. We are looking forward to coming back next week. And I'm very, very curious to see how the week unfolds. And
it's going to be. Look, I can tell you how it's going to unfold. There's going to be one problem after another. The media is going to tell us that. And you know what? Your blood pressure is going to be way low next week, because there will be no problems next week.
Exactly.
It's going to be from high stress to no stress. Next week's going to be cooler than the other side of the pillow.
You have your front row seats for next week, correct?
Oh, absolutely.
Yes, okay.
Yeah.
When they're going to pick you
up. So if I'm not
up?
here, I'm going to be in Philadelphia.
Very good.
Yeah, you know where I'm going to be, Chuck.
Harry, thanks for having me.
Thank you, Chuck Malamut, for all of your financial planning needs. I'm telling you, don't do as I say, do as I do. Turn to the official financial advisor, exclusive financial advisor to the Hurley in the Morning program, and you'll be in very good hands. Chuck is in his 26th year here with us doing this program. He is the managing director of the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010. For all of your financial planning needs, turn to Chuck and his team. You'll be very, very pleased. And the program that you just heard is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. If you want to jump in, we're going to step aside for a couple of minutes, and then we can take another call or two at 609-407-1450. 609-407-1450. We're expecting Dr. Newkirk for the first half of the 9 o'clock hour. I will be placing the call to Ken Timmerman, who is the 10-time over New York Times bestselling author, and he's written a new book that is absolutely incredible. It's the book I've been waiting for. It's the book that breaks down deception, the making of the YouTube video, Hillary and Obama blamed for Benghazi. They blamed this movie, which is nobody knew about it. Nobody watched it. You could go post something today and you would have had more page views than this movie ever had. This is how insidious and how sick these people are. They came up with a way. Hey, I'll tell you, someday we're going to find out exactly who came up with it. Hey, I got an idea. Let's just create a false story. The Innocence of Muslims, the video by Towelface. And they sold that to the world and to the American people. Amazing. Your phone calls are next. Don't go away. We're just going away for a few minutes. Caller, you're going to be with us when we come back right after this.